Welcome to the TAC Index AI podcast, July 1st, 2026, where we blend tech IP data, reports, and charts with the latest news in all things logistics with a focus on air cargo. Today's deep dive explores, a pretty massive contradiction for you guys.
Yeah, a huge one, right?
Exactly. Like, how did global supply chains face an absolute existential energy crisis this quarter, while the S&P 500 just posted its best numbers since 2020?
It is a wild disconnect.
It really is. And after months of extreme market turbulence, we finally have some downward movement in global air freight rates to unpack for you. But the underlying mechanics are doing something really unexpected.
Right, so the numbers show a clear shift. I mean, maybe temporary, but clear.
Yeah.
The global Baltic air freight index dropped 5.0% last week.
Okay, wow. So some actual relief.
Yes, exactly. We're seeing immediate relief at major hubs. Like outbound Hong Kong dropped 6.6% week over week, and Shanghai is down 4.0%.
But I know there's a catch there, right? Because the global average usually masks some pretty intense regional stuff.
You hit the nail on the head. Rates out of the U.S. are actually trending stronger, and overall rates out of China to both Europe and the U.S. still climbed. They just entirely defied the global dip.
See, that 5% global drop feels a bit deceptive then, when you look at the wider context, because rates are still up an incredible 31.3% year over year.
Yeah, 31.3%.
We are hovering well above the highest levels of the last three peak seasons. It's like a stubborn price hangover. It just feels like the absolute floor of the market has been permanently raised.
Totally. And those defiant China and U.S. lanes. That is relentless e-commerce volume out of Asia, plus specific high-tech manufacturing exports out of the U.S.
Which is just swallowing up any capacity relief we might get elsewhere.
Exactly. It creates a two-tiered market. General cargo on secondary lanes gets cheaper, but the high-demand routes remain completely saturated.
Which makes sense for the U.S. pharmaceutical and tech sectors, too. They are securing premium space at really high yields. But let's look at the global 5% easing we actually did see.
Right. The catalyst for that was entirely external to actual cargo demand.
Yeah, it feels completely tied to the June ceasefire extension between the U.S. and Iran.
Absolutely. That extension plunged jet fuel prices almost overnight.
Which is huge because, we are coming off a brutal bottleneck earlier this year. The Strait of Hormuz was effectively closed, choking off, 20% of the world's crude?
Yeah, 20% of crude and middle distillates. Jet fuel spiked over $200 per barrel. And European jet fuel crack spreads hit a record $111.51 per barrel.
That is just insane. That energy spike didn't just make flights expensive, it actively destroyed capacity.
It really did. Operating costs became so toxic that major airlines aggressively cut their flight schedules. They had to avoid flying at a loss.
Right, and it was a direct factor in Spirit Airlines shutting down completely in May.
Exactly. So the ceasefire extension brought fuel costs down just enough for carriers to restore some of those parked frequencies. That injected capacity back into the system and nudged that global index down.
Okay, but I have to push back here. Relying on temporary diplomatic meetings in the Middle East to keep global logistics capacity stable, that is like building a house on a fault line.
It is incredibly fragile.
Seriously, we are essentially one headline away from another massive capacity wipeout.
And honestly, looking strictly at the raw data from Doha and, putting the politics aside to just impartially report what the sources say, the reality on the ground is already shifting again.
Right, how so?
Well, Iran refused to meet U.S. envoys. That immediately dimmed the hopes for a lasting ceasefire.
Oh, wow. So the energy markets reacted instantly then?
Instantly. Brent crude ticked right back up to $73.45 a barrel.
See, this is where it gets really interesting to me. You have this fragile physical network, rising oil prices, and earlier capacity meltdowns, yet the stock market is seemingly ignoring the physical world entirely.
Yeah, they really are.
The S&P 500 and the Nasdaq just posted their best quarter since 2020. Are investors just completely decoupling digital valuations from physical supply chain realities?
If we connect this to the bigger picture, yes. That structural decoupling is exactly what's happening.
Because of heavy tech spending.
Exactly, particularly in AI infrastructure. Software doesn't need to be shipped on a 747.
Right, good point.
So traders are seeing massive margin growth in digital sectors that are highly insulated from a $200 barrel of jet fuel. Plus, on the logistics side, the market often prices in the absolute worst-case scenario right away.
So since total catastrophe didn't happen, it feels like a win.
Exactly.
Yeah.
Tanker traffic through the Strait of Hormuz has reportedly returned to pre-war levels. So the absence of total disaster allows equities to rally, even with a really tense baseline.
Which leaves you with a totally new variable to consider. If the markets are this buoyant during massive physical disruption, it makes you wonder about the future.
Like how AI might change things.
Yes, exactly. How AI-driven supply chain forecasting might permanently alter how we price in geopolitical shocks. If algorithms can soon predict a fuel spike or route around a closed strait before the bottleneck even happens, maybe the days of a single geopolitical event crashing the broader market are actually behind us.
That is a fascinating thought to leave on.
It really is something for all of you to ponder. Till
Mhm.
next time.